Thanks for clicking. Canada's fixed rate mortgages have shot up over the past few weeks, as rising bond yields, stemming from higher than expected inflation, has pushed fixed rate mortgages up over 5%.
Warned you! Didn't I warn you?
The dramatic rise in the cost of fixed borrowing is no doubt going to put even more pressure on Canada's real estate market, which Terranet says suffered the biggest month-over-month price decline since the index was launched in 1999. This comes at a time when RBC says Canada's housing market has never been so unaffordable, and others are warning of a real estate crash similar to the one that Canada saw 30 years ago. So what I want to do today is go over the best mortgage rates compared with last month, take a look at how the higher cost of borrowing will affect affordability in Canada's real estate market, and then discuss what to look for next. The higher than expected inflation rate that came in on Wednesday is putting even more pressure on the Bank of Canada to engage in a 75 basis point rate hike at its rate announcement next Wednesday. We'll obviously have an update out on that announcement on this channel. Click like and subscribe to get that update, but for now, let's get into these mortgage rates. First off, the best 5-year fixed insured mortgage rate. An insured mortgage rate, if you'll remember, that's where you have less than 20% down, you have a 25-year amortization, and you pay the mortgage insurance. And you qualify at 5.25% or the contract rate plus 2%, whichever is highest. The best 5-year fixed insured mortgage rate in August was 4.44. That went up marginally to 4.49 in September and skyrocketed over the past few weeks all the way up to 5.04 in October. So we have a 5-year fixed mortgage rate 0.55% higher than it was last month, 0.6% higher than it was the month prior, and very well could go upwards if inflation remains hot. Next, the best 5-year fixed insurable mortgage rate. The insurable mortgage rate, that is where you have 20% down, you have a 25-year amortization, and you qualify at 5.25% or the contract rate plus 2%, and you don't pay the mortgage insurance. The best 5-year fixed insurable rate in August was 4.79. That remained unchanged in September at 4.79, but that shot up in October to 5.24. or 0.45 higher than it was over the past 2 months. So insured going up by 0.55%, insurable going up by 0.45%. And we also see rising rates at the uninsurable level. Uninsurable mortgages, if you'll remember, that is where you have 20% down, but you qualify at a 30-year amortization or you take money out of your home, vis-a-vis a refinance or an equity takeout. And you still qualify at 5.25% or the contract rate plus 2%, whichever is higher. The best uninsurable rate in August was 5.24. That remained unchanged in September at 5.24, but shot up in October to 5.54, or 0.3% higher than it was the month before. So the best insured, the best insurable, and the best uninsurable mortgage rate all went up in October as a result of rising bond yields, which rose due to the higher than expected inflation.
What would you say you do here?
But what has this done to affordability? The best 5-year fixed mortgage rate in September was 4.49, and the average price of a home in Canada was $640,000. Using minimum down payment requirements and qualifying at 6.49%, to buy that average home, you needed an income of $150,000. However, if we take that same $150,000 and we use today's 5.04% contract rate and qualify at 7.04%, that same $150,000 now only qualifies for a purchase price of $615K with minimum qualification standards. So we have a $25,000 reduction in buying power since this point in time last month. And the reduction in buying power is likely to be very similar with variable rate mortgages, as the Bank of Canada is set to raise rates by a minimum of 50 basis points, maybe 75 at their meeting next week. And it doesn't look like this is going to be getting any better anytime soon, as the Bank of Canada has shown no signs of slowing down in its rate hiking cycle, and the Federal Reserve is now expected to be raising rates up to 5% by early next year. And as we've seen over the past few months, there's often a lag between mortgage rates rising, house prices falling, and then rates rising again. BMO, just a few weeks ago, which we've covered on this channel, said that the current real estate market is being propped up by pre-approvals from just a few months ago. with fixed mortgage rates going up by 0.3% to 0.55% over the past couple of weeks. No doubt in a few months from now, we'll be talking about how that real estate market is being propped up by pre-approvals that were obtained today. So if you are planning on getting into the market, the best thing you can do is get that pre-approval rate, get that rate hold in place, which is good for 120 days. So you will be able to take advantage of today's rates at tomorrow's prices. Variable rates, on the other hand, rise and fall at the whim of the Bank of Canada, so a rate hold won't be any use if you are going with a variable rate mortgage. We will have an update out on variable rate mortgages when the Bank of Canada releases its update next Wednesday. Click like and subscribe to get those updates, but for now, thanks so much for watching.